Look closely at any major city today, and you will witness a bizarre, generational migration. Millennials and Gen Z travelers are abandoning aesthetic mountain cabins and downtown lofts. They are returning in droves to the neon signs and predictable lobbies of traditional hotels. They are celebrating the innovative luxury of daily maid service, front desk luggage storage, and key cards. They are fleeing back to the very institutions they were supposed to help destroy. At its absolute peak, this platform was valued at an astronomical $116 billion. It possessed more cultural dominance than Marriott, Hilton, and Hyatt combined. It wasn't just a company, it was a verb. It fundamentally altered the global real estate market, dictated urban planning, and spawned an entire generation of internet hustlers who believed they had unlocked the cheat code to infinite wealth. Yet today, the calendars are entirely empty. The Jenga tower is violently swaying. Former superhosts are bleeding thousands of dollars a month, liquidating assets and watching their passive income dreams violently unravel. A platform built on the promise of human connection and cheap travel has somehow morphed into a dystopian, overpriced chore simulator where paying guests are treated like untrustworthy, unpaid labor. This is the autopsy of the greatest bait and switch in hospitality history. To understand the magnitude of the fall, you have to look at the sheer genius of the origin. In October 2007, Brian Chesky and Joe Gebbia were broke industrial designers staring down a 25% rent increase on their San Francisco apartment. They had no equity, no leverage, and no cash. But they noticed a massive design conference was coming to town, and every hotel within a 10-mile radius was fully booked. They bought 3 air mattresses, inflated them in their living room, and put up a rudimentary website offering a place to sleep and a homemade breakfast for $80 a night. 3 people showed up. The founders made a quick $240 and accidentally discovered the most lucrative, asset-light business model of the modern era. The timing was terrifyingly perfect. The 2008 financial crisis was about to shatter the global economy. Foreclosures were rampant. Everyday people were desperate for cash to save their homes, and travelers were equally desperate for a cheap place to sleep. Traditional hotels were utterly exposed. They were carrying massive overhead, paying armies of staff, and maintaining giant, expensive buildings. The startup had 0 properties, 0 maids, and 0 mortgages. They simply provided the digital infrastructure to connect the desperate with the frugal. Silicon Valley initially hated it. It sounded like a massive liability. Investors thought strangers would simply rob each other. But the founders persisted, famously surviving by selling novelty political cereal boxes, Obama O's, and Captain McCain's to fund their servers. Eventually, Y Combinator took a chance on them. The platform instituted a mutual review system to build trust. It forced hosts to take professional photos of their spaces. The traditional hotel industry was supposed to be taken out. Why pay $250 a night to stay in a sterile, beige room in a tourist trap when you could pay $80 to stay in a bohemian loft in the coolest neighborhood in the city? The company offered an authentic, localized experience. You were living like a local. It felt like a massive cultural win. We were all rooting for them. Fast forward to the pandemic. The world locked down and the traditional hospitality industry nearly checked out early. Hotels sat completely empty, hemorrhaging cash. But the home-sharing platform did the unthinkable. It thrived. Remote work had severed the chain between the office and the employee. People realized that if they had to quarantine, they did not want to do it in a cramped city apartment. They wanted a house with a backyard in Joshua Tree, a cabin in the Smokies, or a beachfront property in Florida. They started booking stays not for days, but for months. On December 10th, 2020, the company went public. It was a financial bloodbath in the best way possible for early investors. The stock opened at $146 a share, skyrocketing 112% on its first day of trading. The founders became billionaires instantly. The war chest was completely overflowing. This triggered a secondary, far more dangerous gold rush. Enter the era of the TikTok host. Social media became saturated with 22-year-old finance gurus standing in front of rented Lamborghinis, aggressively selling courses on something called rental arbitrage. The pitch was intoxicatingly simple. You do not even need to own a house to get rich. You just sign a long-term lease on a trendy apartment, furnish it with cheap mid-century modern knockoffs, and sublet it on the platform for triple your rent. It was touted as the ultimate passive income machine. Capital flooded the market. Institutional investors and amateur mom-and-pop landlords began buying up residential properties at an alarming rate, artificially inflating neighborhood housing prices. Mortgages were secured at record low interest rates. People were leveraging their life savings, buying 5, 10, or 20 properties exclusively to list them as short-term rentals. In 2021, the golden goose was laying diamond eggs. You could list a poorly converted garage, take a photo of it with an iPhone, and be booked out for 6 months straight. The demand was entirely insatiable. They had achieved total, undisputed market dominance. But an empire built on leverage and greed always develops a fatal blind spot. For this platform, the rot started with the pricing algorithm and culminated in a massive psychological betrayal of the consumer. Let us look at the math. A traveler logs on to book a weekend getaway. The map shows a beautiful one-bedroom apartment listed at a highly competitive $150 a night. The traveler clicks book for a 2-night stay, expecting a $300 bill. But they arrive at the checkout screen, and the total is $580. This was the surprise. The bait and switch had begun. The platform allowed hosts to artificially lower their nightly rates to dominate the search rankings, and then backload the true cost with extortionate, non-negotiable fees. There was a $60 service fee. There was a local occupancy tax. But the absolute final nail in the coffin was the cleaning fee. Hosts began charging $200, $300, sometimes $400 for cleaning on a 2-night stay. They blamed the cost of hiring local turnover crews. The financial reality was much darker. The cleaning fee became a hidden profit center. It was a completely unregulated shadow tax. This was hidden revenue. And then came the chore list. You are paying top-tier luxury hotel prices, but the morning of your departure, usually at 10 a.m. or even 8 a.m., checkout time, you receive a multi-page manifesto from your host. You must strip the bed sheets and start a load of laundry. You must wash, dry, and put away all the dishes. You must gather all the trash, exit the building, and locate the municipal dumpsters 3 blocks away. You must wipe down the counters. You must turn the thermostat to exactly 68 degrees. The chore list had arrived. If you fail to complete this unpaid labor you already paid $250 for via the cleaning fee, the host will hit you with a 1-star review. The psychological dynamic completely inverted. You were no longer a valued guest on vacation. You were a hostage in a stranger's house. You were walking on eggshells, terrified of leaving a watermark on a cheap IKEA coffee table. Hosts began installing Ring cameras at the front door to monitor exactly how many people entered the property, policing noise levels, and sending passive-aggressive text messages if the air conditioning was left on while you went to dinner. Privacy vanished, and trust eroded. The company had entirely forgotten its core product. It forgot that hospitality requires, fundamentally, hospitable behavior. They allowed their hosts to become arrogant, entitled landlords who viewed guests as annoying, dirty inconveniences that owed them a profit margin. The cultural sentiment violently snapped, and the internet began mocking the platform relentlessly. The contrast was too stark. For the exact same price, a Marriott offered zero chores, daily fresh towels, absolute privacy, and a front desk clerk who smiled when you walked in. By late 2023, the consequences of this hubris materialized. The Jenga tower started dropping blocks. The post-pandemic travel boom normalized. Inflation ripped through the economy, shrinking the middle-class discretionary budget. But the supply side had completely mutated. There were simply too many short-term rentals on the market. The amateur investors who had taken out massive loans to buy up those cabins in Joshua Tree suddenly found themselves staring at completely empty calendars. Supply was overwhelmed. The phrase Airbnb bust began trending globally. Revenue per available room plummeted by as much as 40% in formerly lucrative, saturated markets like Austin, Phoenix, and Orlando. The math broke. An investor who bought a property at a 7% interest rate needs a 75% occupancy rate just to break even. When occupancy drops to 30%, the host begins bleeding massive amounts of cash. They are personally subsidizing a vacant property. Panic set in. Facebook groups and Reddit forums dedicated to short-term rental hosts became digital support groups for financial ruin. Hosts complained the algorithm was suppressing their listings. They complained that guests were becoming cheap. They refused to accept that they were entirely responsible for unaliving their own market by offering a terrible, overpriced product. The corporate fallout was equally brutal. Look at Vacasa, the largest short-term rental property management company in North America. They were supposed to be the institutional winner of this ecosystem. At their peak, their stock was trading at over $10 a share. By 2024, it was trading for literal pennies, dropping over 99% in value and facing delisting from the Nasdaq. The sheer overhead of managing thousands of depreciating unbooked assets in a saturated market dragged them into the abyss. The platform's executives scrambled. They forced redesigns. They tried to implement transparent pricing toggles so users could see the total price up front. They pleaded with hosts to lower or remove cleaning fees. They attempted to ban indoor cameras, but it was entirely reactive. The brand damage was completely locked in. They had spent 3 years training the global consumer base to expect hidden fees, paranoia, and physical labor. You cannot unring that bell. While the platform was fighting a losing war on consumer psychology and oversaturated supply, the fatal blow came from the government. For a decade, local municipalities had warned that short-term rentals were gutting residential housing. Landlords were evicting long-term tenants to convert apartments into ghost hotels, severely restricting housing supply and driving up rent for locals. The cities finally mobilized, and they deployed absolute legislative firepower. On September 5, 2023, New York City dropped the guillotine. Local Law 18 went into strict enforcement. The law did not ban the platform outright. It did something much more clever. It required all short-term rental hosts to register with the city, and it explicitly mandated that the host must be physically present in the apartment alongside the guest for stays under 30 days. No entire unit rentals were allowed. It was a total massacre. The city erased roughly 15,000 listings from the map overnight. Fines for illegal hosting were set at $5,000 per violation. The company fought back in court, claiming the rules were a de facto ban. The judges threw the cases out. New York City, one of the most lucrative tourist markets on the planet, was effectively permanently closed to the platform's core business model. And it was not an isolated incident. The regulatory contagion spread globally. Barcelona announced a plan to revoke all short-term rental licenses by 2028, completely eliminating the market in the city. Paris deployed dedicated enforcement teams to hunt down illegal listings. Dallas restricted short-term rentals strictly to commercial zones. Irvine, California, functionally banned them entirely. The platform's most profitable high-density arteries were being surgically severed. They were no longer the lovable, scrappy startup disrupting big hotel chains. They were viewed as an aggressive corporate parasite destroying local housing infrastructure, and lawmakers were highly incentivized by angry constituents to take them out. When you lay the body on the table and examine the timeline, the cause of death is incredibly straightforward. It was an acute failure of customer empathy, poisoned by rapid, unregulated scale. The company solved a massive problem in 2008. They commodified trust and utilized empty space, creating genuine value for both sides of the transaction. But the moment they went public, the incentive structure warped. They stopped serving the traveler and started exclusively serving the host. They allowed greedy amateur hoteliers to dictate the terms of engagement. They let the passive income cult destroy the platform's reputation by demanding luxury hotel prices while forcing the customer to do the housekeeping. They successfully executed the greatest organic marketing campaign in history for traditional hotels. They reminded an entire generation exactly why the hospitality industry standardized service in the first place. You cannot scale a hospitality business by treating your paying customer with suspicion and manual labor. The ultimate lesson here is terrifying for any modern entrepreneur. You can have a brilliant idea, infinite capital, and total market dominance. But the moment you allow your suppliers to extract maximum value at the expense of your core customers' dignity, your business model has already passed away. The Jenga tower will always fall. It is just a matter of who is standing underneath it when it does.